Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our next topic after the close. I am your host, Kevin Horner. I want to thank you all for being here today. We've got a market that is suddenly feeling a little bit bullish again. We'll see how the charts look a little bit today. And we're also going to essentially set the table for tomorrow's action based on what we see from the close here today. So hello to so many familiar names and faces there in the chat. Always great to have you, frequent attendees. Love hearing from all of you. I've got Michael Fairborn joining me in the chat today. You are welcome to engage with Mike. He'll answer comments and questions that I'm unable to get to, but you know I'm going to keep an eye on things there. I do want to answer those questions on the fly as best I can and make sure that we're getting to those details for all of you. You can expect me to be sharing some detail with you today, specifically some scans, and I'm happy to do that for you because we're going to be starting with a bit of a different approach than you might have expected. So we will look today at a bearish opportunity or two. We're also going to look at bullish opportunities, of course, and then review our example portfolio. We did have a couple of trades that we placed last week that came to pass. So they actually got executed. We'll look at what happened there and see if we need to close anything out. So with that, let me just remind you that you can follow Mike and me on X. We're available there, Mike Fairborn CS, and I'm available, Kevin Horner CS. Without a doubt, X is the best place to meet up with us coaches when we're not hosting a class here for you. So we would absolutely appreciate a follow there. With that, let's jump to our disclosure detail and we'll get into the charts. I'll first remind you that our conversation here is exclusively for your information and your education. We do not make recommendations. We also do not endorse any particular approach to trading the market. We do cover and discuss technical analysis. Just remember that this is just one piece of your decision-making puzzle, not the entirety of it. So we discourage you from making decisions exclusively off of what you receive in the way of technical analysis. We will discuss options today. These carry a higher level of risk. They are not appropriate for or suitable for all investors and traders. You do need to be approved on each individual account in which you would like to trade options at Schwab. So make sure you go through all the requisite steps there. And finally, remember that we work in a paper money version of the Thinkorswim desktop application. In doing so, as the seller of an option, if you're utilizing paper money, you will never receive an early assignment on a short option. However, in life, in reality, using your real account, you absolutely can be assigned at any time that you are short an option contract. That can even include times when you are way far away from expiration and also out the money. So please keep all of that in mind. Now, when we get started here, essentially, we do so with a quick look at the broad market. We're going to see how things changed and closed today, and that'll help us understand where we can consider looking for our opportunities for tomorrow and perhaps the remainder of the week. So with that, I'm going to bring up the Thinkorswim desktop application, and we are going to take a quick look at the S&P 500 right off the get-go, just to get a snapshot of what happened today. And I think the biggest takeaway for many a trader here is an excellent move off of my horizontal support line right around 65.40 or so. This was tested a number of times over the last couple of months, as you can see. Since mid-September, we came back and tested it, at least once or twice here, once and twice here, back-to-back days, and now we've managed to move off of it. The fact that we've not given anything back over the last 4 sessions is kind of a positive, of course, so we don't mind that one bit. And the fact remains that we've got a little bit of a gap zone in here. We had to work our way through this in order to hold a level, and we did that. And so now you've got 4 days above that little bit of a gap zone. So depending on how you choose to view the market, some of you will view this very short term, and others will say that's way too short term, Kev. I'm paying attention to that green line because a change there will give me some insights as to the potential for a deeper pullback in the market. So that 65.25, 65.35 zone there, probably a very important one. Doesn't mean we have to revisit it near term, but it's certainly an area that if we closed beneath it, we would likely see a bit of a shift in terms of sentiment and comfort with the S&P 500. So a very nice development over the last week and a half to 2 weeks here, having dropped so significantly when we got the idea, the impression perhaps that we weren't going to be getting rate cut in December. And a lot of that conversation and narrative has shifted quite a bit over the last week. Now, if we look quickly at the NASDAQ 100, that is, you're going to see us moving to a new short-term high. Now, at this point, a lot of traders are going to say, hey, we are just a stone's throw from our all-time highs up here around 26,000 on the NDX, the NASDAQ 100. And they aren't too wrong, to be quite honestly. I mean, we're very close to it. So if you're trading the trend, a lot of similar detail here relative to the NDX, a level of horizontal support, have moved off of it quite nicely and are into another level where, from a trend standpoint, we're back above that 50-day and have been now for 4 sessions. So NASDAQ showing a little bit of leadership here and a little bit of bullishness. And certainly if I cleared out my rangy horizontal lines, we could just look at this type of a deep pullback, which wasn't terribly deep, but it was deep enough. In fact, if I tried to define it for us, let's see, we made our high here on the 29th and it was at 26,182. If we drew a line to the lows on the day we made the low that day was 23,854. So if I just tried to come into a vicinity of that, this line, okay, so we pulled back just shy of 9% in the NDX, the peak to trough move. So an appropriate pullback. And Mike and I had recently hosted Trader Talk together, and he's reminded me that, hey, we get these 9 to 10% pullbacks over time. These happen about once a year on average. You get that 10% pullback. Very commonly, 3 to 4 times a year, we'll get that 5% pullback. It's those deeper ones that challenge us as traders. And here, the fact is we moved off of that level really well and have kind of put ourselves right back on trend with the NASDAQ 100. Now, you're going to see as we look at this, that doesn't mean that everything in the NASDAQ 100 is up, but it does give us something to work with. Last thing we're going to hit on quickly is the Russell lone red index today, pulling back a little bit, but this has also made a significant bounce back because the narrative changed so rapidly over the last 2 weeks. The bounce off of support here, remember, technical analysis 101 stuff, this was resistance, and what once was resistance can then act as support when we move through it. Well, that's exactly what we did here. We took a pause on this day, had to come back and test our 20-day moving average before we continued on. And that's exactly what we got, right? So we moved through it. And then once through that horizontal level of former resistance, it could then act as support. And that's exactly what happened. And granted, it bounced from here because the narrative really changed. We'd heard from some of the Fed governors that the expectation for a December rate cut was perhaps higher. And a lot of the conversation amongst governors in the last meeting initially was stated as being kind of, hey, we don't necessarily need to make a cut in December, but apparently there were a lot of dissension. There was a lot of dissension amongst that view of the Fed chair, and so that commentary has led Russell and small caps to bounce back as the expectation for a rate cut on next week, the 10th of December, has pushed almost to 90% again. So, and granted, those rate cut expectations are just how traders position, but that expectation, that conversation is why you've seen such a significant bounce back here. Now, the next step in looking at the 3 major indices is to try and find our leadership group. Where are we getting potentially the best opportunities? Well, a couple of things we can do. We're going to start with the Market Watch tab, and we're going to my quotes page. And I have loaded here the 11 sectors of the market, the same 11 that are over here. And then I'm sorting them by our relative strength versus the last 21 days. So remember, 21 days, an approximation of the number of days, trading days in a calendar month. So it's either 20 or 21 most months. And this gives us an idea of what's been leading for the last month. We can see that that has been communications, materials, healthcare, and staples, couple of things stand out to me there. I don't know about you all, but 3 of those top 4 kind of fall into the defensive category. In terms of our laggers, well, utilities as rates have we had a change in rates, but utilities are lagging here. Real estate also rate sensitive, lagging. Industrials, energy, and there's tech. Tech at the now that when I started building my work for this class this afternoon, tech was a bit lower, and there's been a bit of a rally here. Now, one other consideration that you traders might look to is not just the 21-day, but also the 89. Now, the 89 is a little longer than 4 months, but the idea being trying to find a longer range trend. And in the longer term, you can see that our leadership, interestingly, communications, healthcare, and there's tech. So in the last month, tech has been one of the lower half returners, right? The lower half producers, but over the 4-month period, it's been a leader. So you can look at that a couple of ways, right? One way would be, all right, we've got a group that's not really leading like it was for the last month. It hasn't been. Maybe there's a shift underway underlying the market, and we might want to consider potentially bearish opportunities in technology. Conversely, a trader in the longer term might look at that level here being the 3rd of the 11 groups over the 89 days and say, well, we've got leadership over a longer term, 4 months approximately, but in the last month it struggled. Maybe what we're going to find are opportunities in technology in stocks that have pulled back to areas of potential support. So you could look at that either way. As usual, it's imperative on our parts as traders, we must define our time frame. We must know, am I looking for a stock for a short-term play, or am I looking for something with a little longer-term play? Or maybe I'm going to get an opportunity that is going to start as a small-term opportunity that develops into a longer range hold simply because I caught it at the right time. That could also play a part in your trade process. So some evaluation of this led me in my prep to think, let's consider technology, but let's consider technology from a bearish standpoint. We haven't done that a lot lately for obvious reasons. We don't have a ton of bearish conversations in the midst of a pretty strong bullish market, but I wanted to give you some ideas of ways to incorporate bearishness and maybe give some consideration to it. Now, today for our example lead off, we're going to start with technology, and we are going to lean bearish. So we're going to move to my scan tool here, and I'm going to load a predefined scan that I've built that is downtrending, fairly generic in nature, but let me explain what this particular scan is doing. So all I've done initially is to define my price as anything over $10 a share. That's the first thing I'm going to look at. The next is a custom set of studies. So I'm going to click my pencil, and when I do that, I get my pop-up box that I will bring over here. And let's just work through this briefly. Many of you who are frequent attendees, you're going to be a bit more familiar with this, but I wanted to walk through this for our new attendees, of which we've got many, I am sure. And I just want to give you some understanding of what we are scanning for. The first thing is stocks whose average volume over a defined window of time is at least 500,000 shares. So this way we find stocks that we can enter and exit, right? We should be able to enter our trades, exit our trades. Enough liquidity will be present for us. Additionally, I'm going to look for a stock whose 10-period moving average, exponential moving average that is lower than its 50-day exponential moving average. Now, I'm using exponentials on this just to illustrate that you don't have to do this with simple moving averages. You can do it with exponentials if that's your preference, or you can change things up, essentially. But that's what I've built this one on. So it is, the first one is a short-term moving average like the 10-day below a 50-day. Additionally, we've got stocks who are reflecting a short-term relative strength, like a 15-period RSI being lower than a 30-period RSI, which tells us over the 15 days, 3 weeks, we've got a weakening trend relative to the 6-week view, right? The 30-day length. So you should see a weakening trend and thus a downtrend potentially playing out. Now, additionally, we're going to look for stocks who are last traded or today now closing below their 20-day exponential, below their 50-day exponential, and below their 200-day exponential, which tells us that we should be finding downtrending stocks over 3 different windows of time: the 20-day window, the 50-day window, and the 200-day. Okay. Now, I understand, and I see your comment, Jay. I think what you're saying is that you might not touch a technology stock bearishly, and I can understand that. But I'll remind you that even in the best groups, there are going to be laggards, and there may very well be a few stinkers in the midst of that. So we're going to look for it, and we'll see what we come up with. I did not find a list of 0, I can tell you that. Okay, so let's take a look. I'm going to take all those criteria. We're going to scan in the S&P 500 and intersect with technology specifically. Here's how I did that. If I cleared the filter, we just go to the intersect, drop down, go to industry, and select technology. And here we can get specific, right? We can detail this into sub-industry groups if we wanted, but we're going to select all of technology and hopefully find some downtrending stocks. Now, I hit that scan button, and sure enough, we have about 7 or 8, actually, turns out 8. So I wanted to look at a couple of these initially just to show that there are going to be some ones that are struggling, right? So let's start with one that was cruising along not that long ago. Intuit was absolutely cruising. Look at that, an 816 high back here at the end of July. Well, unfortunately, since then, it's just gone gangbusters to the downside. If we take a look to the low that we made this last week or so, the pullback here has been 24% from the peak to the last trough. So not a winner and below some major levels. You do have a declining trend line here. We fell through a ledge that some would call supportive in nature. And that looks like a declining or descending triangle that has broken to the downside. And I'll remind you all, if you look at this chart and you're saying, well, I've got reasons to be bullish here, and I can understand maybe a trader feels like that's the case. So if you want, or if I've shown you this before, but I'm going to do it again. If you're struggling visually with a chart and saying, I can see bullish patterns, I can see those really easily, it's bearish ones that confuse me or cause me strife, well, then flip over the chart. So I'm just going to put a minus sign in front of the symbol and reset it, INTU minus, and now I've got the inversion of this chart, okay? The literal inverted of it. Now, if I look at this, so let's say that you were looking at this pattern and saying, boy, if I were bullish and we broke resistance to the upside, I'd be looking at this as an opportunity to play for more upside. Well, now we know we've inverted this chart. That should speak to the bears now associated with Intuit, because if we take and flip that over, that line I just drew is this one right here. And so what once was support can now become resistance, and some traders might use that as the decision-making level, either the red line or maybe the 20-period orange moving average to the downside. It is really hard for some of us to see those bearish patterns. Inverting the chart can really, really help out. Now, we're not going to do an example on Intuit, but I'm glad that it populated the chart or populated my scan. We are going to look at another one here real briefly, Oracle, which recently, we were told not that long ago that you could do no wrong if you wanted to own Oracle. Look at the massive gap move. But since, unfortunately, that has just been nothing but giving it back. And I'll tell you, if you've never heard the idea, my goodness, 46% over 55 bars, 11 weeks, and it's pulled back 46% after having made a new all-time high. I mean, if there were a better explanation for why traders incorporate exit strategies, even when you buy big gap moves to the upside, you know what? There's been some opportunities in here to lighten up. A couple of which were the keys here, like a lower high, followed by another lower high, followed by more lower highs. And so now you're trending negatively against the 20-day moving average. We've been below the 20-day all the way back to October 17 now. So you're looking at 6 weeks below the 20-day. Now, why am I doing this? It's not as a reminder of mistakes previously made. My hope is that it's a learning opportunity. Another pullback here. Look at the level we held and stayed at on the 50-day. You'd have every reason to maybe maintain a position here at this point. But then on the day it broke that level, boy, was that your last chance, wasn't it? Even if you sold at the low that day, it was 256, and you didn't have to write it down to 185. Mind you, that's a 25% move just from the low of the breakdown day. Okay. Again, the imperative nature of knowing the levels where you will make your decisions is key, right? So that's why I'm bringing this up. And again, a couple of stocks that maybe you didn't think would be negative on the scan. Okay, let's look at the one we're going to do an example on today. We are going to look at ServiceNow. ServiceNow has also been in a bit of a downtrend. We could draw some resistance in here, as you can see, some level that we've rallied to before. Rallied, failed a number of key times, right? So there's a pretty good resistance banner. And then we can draw maybe an angled downtrend line like so, somewhere in this vicinity. And you can clearly see we are below the 200 in blue, below the 50 in purple, and below the orange 20-day. Now, the interesting thing here is we've just taken out, with this action of the last 2 weeks, another zone that could have been considered support. Well, we clearly broke it. And then not only did we break it, everybody, we've stayed beneath it for 2 weeks. So here we are, 2 weeks below former support, now potential resistance, and running ourselves into the 20-day moving average. I thought if we were bearish and looking for bearish opportunities, this presents itself as a clean, considered opportunity. Clean in the sense that we've not just broken below a level for a day, but we've actually given this stock the opportunity to confirm that breakdown by trading below that level for now 2 full weeks. So if we are feeling bearish as it relates to ServiceNow today, what type of trades can we consider? Well, if you want to be the seller of options, you might consider selling a call spread, something above, say, that 840 zone, in the effort to try and bring some premium in. Alternatively, some traders would look at this as their chance to maybe buy a long option. Okay, so maybe it's a long put spread, which is what we're going to do for our example here today. Now, Rocco, you're not wrong. Let me take a look, and I'm going to apply my exponential studies here. So here are my, okay, so we've got the 10 in that light blue, the 20 in that pink, and in orange, light orange, that is, the 50. So the 10, the 20, the 50 exponential moving averages. So yes, we are now above the 10. And but we don't have any crossovers just yet, right? The 10 and the 20 are residing above us, or we're sitting on the 10. So this could amount to potentially the beginning of a bounce. And yet the level above us presents as resistance. And we also tried to stay with a high trade today, meaning we tried to close above the high today, or stay up versus our open today. We didn't. So yeah, we closed above the 10-day, but if that candle were green and maybe, we closed at 834 where we got our high today instead of 824, some traders might be inclined to feel a little more bullish. But buying down here feels a little bit like a counter trend effort, right? You'd be buying into a downtrend that has not, as of yet, corrected. I could see a trader considering starting small and hoping that tomorrow we're not right back beneath that level. But when I look at it, today is the highest we have traded since back here on the 18th. And if you take, let's say tomorrow we close below today's low of 824, well, then that so-called hold it immediately turns into a close below the low of the high day in this very quick bounce that we got. So with that in mind, I think traders, we just need to be reminded we are looking at a downtrend, okay? We've got a downtrend that's been in place for a while. So any bounces can be considered opportunities to continue that downtrend. If it's going to become an uptrend, I mean, short-term uptrend, first thing we got to do, we got to get through 840, right? That could be something that changes things. And then the next one is way up there at 910 or so, the 200-day moving average and the confluence of the downtrend line. So I'm not going to argue, Rocco, that it did that. It did close above the 10-day today. But if I want to be bullish, I'm probably looking from into a pattern that is already showing me higher highs and higher lows. Okay? So that's the reasoning for what we're looking at here today. Now, the levels that I wanted to give consideration to, because in this example, we're going to go with a long put followed by a short put. We're going to be willing to cap our upside on our trade by selling a contract at the same time that we buy it. So we're going to buy an in-the-money put contract and sell an out-the-money put contract and try to make the difference in between it, okay? So here's how we're going to set that up. Remember, our level above is 840. And when we're considering options for this, we want to go out probably 2 weeks time frame, maybe longer. Some of you traders might want to go to January. But remember, if we go to January, we're going to have a lower delta if we're picking the same strike price because we have more time remaining. So I'm looking at the 19th, and here's what we're paying attention to on the put side. I was looking at the 850s because, granted, the 850s only have about 100 contract, 96 of open interest, not immense volume, but I'm not looking to trade more than one, so I'm not going to have a huge trouble here. But look at the difference. The delta here at the 850 is 63 cents. So remember, 63 cent delta means that it moves, this contract will move approximately 63 cents for a $1 move in the price of ServiceNow. We could also look at that as the potential likelihood that that contract is in the money at expiration, which is why a trader might want a higher delta position. If you're going to own the contract, you want to own a higher delta because it gives a greater likelihood that not only will this contract be at expiration in the money, there will be value left even if the trade doesn't necessarily work out in your favor. So that's what we're going to do. We're going to look at the 850, and then I'm going to suggest that we try and make something like 30 or 40 points on the spread. So if we're buying the 850 put, we want to maybe sell the 820 or the 810 or maybe even the 800. You know, think about this for all of your processes, everybody. But let's do it with the 820 so that we can mitigate our cost a little bit here. By the way, I wanted to mention, I called out the difference between these strikes over 2 weeks. So December 19, 850 strike, 63 cent delta. But if you give it more time, like 2 more weeks, that same contract, 850, is a 60 cent delta. Okay? So, and notice, pretty good difference here in terms of open interest. At least the 2 week out has nearly 100 contracts of open interest. So these are a little bit different, not extensively different, right? But just a little bit. Okay? So let's put this one on. Let me go from the 850 to the 820, we said. So that's a 30-point spread. And I got that to populate just so you could see this, everybody. In order to get that other contract in there, I just held the control button down and clicked the bid, and that's what gave me the fill in the second level here. So 820, 850 long, 820 short, which sets us up for a 30-point spread, and we can make the 30 points less what it costs to put on the spread. Now, the midpoint here of those is 1765, and it's said to be the natural is 22, but we don't want to be too fine in our approach. But if we were buyers at, we're not going to be a buyer at 43. We'd be somewhere in between that and be like right around 40 points, right? And selling for about 22. We should be able to get in for something like 18 to 19. All right, so let's go in there at 19. We're happy to get it if we can get it for 19. And just remember, like I give you that math once more, the spread is 30, and on a long put spread like this, or like any long spread, 30 points is what is the maximum we can make. If it costs us 19 to put it on, we can make the difference, 11. So yes, we will be outlaying 19 to earn 11. Yeah, Jeff, fine, let's do that. Why not? Right click in the chart, or excuse me, in the order to analyze the trade, and that'll give us the risk profile so that we can see it right here. All right, and so we would want to kick this out to our 20th, give you an idea as to where break evens reside. There you go. So your break even is down to 831 essentially. So there's your risk profile on the viewpoint there in the Analyze tab there, Jeff. So you can see that basically when we sell this, long the 850, short the 820, obviously under 820, this is, as long as it stays under 820 or is at under 820 at expiration, we get maximum gains. But we could walk, away from this. You've got a lot of wiggle room here, because even though we're doing a 30-point spread, you're starting in the money on your long side, and your short side is only 5 points out. So pretty intriguing scenario there, where you can be on this example still profitable without going lower than the 800 level. Heck, we don't even have to go down more than 5 points for this to remain profitable. If we were to stay rangy between 800 and 820, then we're looking at a full profit trade eventually at the conclusion. So that's the concept that I built here. So that's what we're going to do. Now, the reminder, like I said, we've got to give this a little bit of a padded limit effort, right? We got to increase our willingness to pay for the spread, because it's after market close. We can't know what the open's going to look like tomorrow. So this is a bit of a padded limit. It's likely to open in a level under this, or in a range that would execute, but we can't guarantee that. So I'm going to make this trade good till canceled, and then hopefully between now and next Tuesday, when we come back, we will go ahead and see that we've put this trade on. So there you go, a bearish scenario. And again, 1,100 our maximum profit, 1,900 our maximum loss, and we only reach max loss if we carry this to expiration and the stock is above 850 at expiration. So keep that in mind. So let's go ahead and send that one off, and we are all good. Now, we are all different, and we've highlighted a bearish example, but we could just as easily turn this into a bullish example utilizing S&P 500 and technology. We can just, I'm going to go, for example, back to my scans, and we could do the exact same thing here with uptrending in all times, maintain S&P 500 and tech. Now I've got these in there. These are using 20, 50, and 200 simple moving averages, but we could do that too. And there you go. And now you've got 26. So maybe traders, you take a look at this and say, well, I've got 26 bullish opportunities, 8 bearish opportunities. The numbers may suggest, maybe that changes the view. Maybe that means if I got 3x the opportunity bullishly that I have bearishly, maybe that tells me something as well. So just wanted to highlight the way to do that. And again, I did want to share that bearish scan because there's been so frequently that we get to the downtrending. So let me share that one with all of you here. Share scan query. And then I'll remind you that all of our scan scripts or grid charts or any of this stuff, just remember none of this is guaranteed for accuracy nor the timing, and they are not a recommendation for your use. Yes, I did alter my order to be that of a good till canceled. Not every trader is going to want that. Some of you are going to look at the market only after hours and you look once a day. And then you might want only a day only order for tomorrow's business. You might consider just doing that. That way you can redo all of the same thing you did tonight, do the same thing tomorrow. Your levels can change, everything can change. So keep that in mind as well. Okay, we have to take a look at our existing example portfolio. But before we do, I want to remind you, I've got my after the close watch list in here. And the reason that I've got it in there is so that I'm reminded to look through it. Look, if we're not looking at our watch list of potential stocks, potential trades every single day, then we're missing out. I've said it before. I think it's imperative that you keep an eye on as many as you want. Maybe it's 20 stocks, maybe it's 50, but you got to look through your charts. You got to find those that are moving. Credo, moving to a new high. Not the best candle today because it was way higher at 213, sold off 30 points, right? So maybe that's a different view. Here's the ASTS, AST Space Mobile, sitting at support. Hey, here's strategy, rolling lower, moving negatively against that 10-period EMA. Let me change all my studies back to my standards. Even, my goodness, we're below the 20 quite aggressively. Some of these you're just going to find, my goodness, what about our quantums? Quantums were hot for a while, completely unwinding as we speak. Most of these below the 20-period moving averages, if not more. Here's app trying to get outside of that range. Might be a little notable that it tried to bust through and couldn't. But this is what I like to do, man. I tell you what, everybody, I just go through these charts. I go through these watch lists every single day as much as I can. There's another one, Coinbase, rally into the confluence of the 20 and the 200. Couldn't get back above the 200 there, could it? Couldn't get above the 20. Nice little bounce, but kind of presents as a bit of a, come on, everybody, say it with me. Bear flag. Ugh. Not ideal for Coinbase. Oscar, not really trending one way or the other. Trying. Apple, new all-time highs. Hopefully you're not missing the boat on that one. My goodness, what an incredible pop this has made since April's lows. Look at that. April lows. Oh, a mere 70% in one of the largest companies in the country. So I hope, if nothing else, I'm reiterating the imperative nature of looking through our watch lists. Set your levels. Know where you have opportunity. Take chances where you feel comfortable. All right, let's look at our example portfolio that we had. Oh, thanks for asking. We essentially, this has been built over time. Started with me bringing some patterns and detail scans, and I just keep throwing symbols into it every week. Anything that popped that looks interesting, I just keep throwing them in there. It's not a list that I can share with you, unfortunately, but you're welcome to make note of these symbols. Okay, we're going to jump to my example portfolio, and we're going to look at the two that we've got working here. We put on a trade in 4 a few weeks ago, and last week we toyed with the idea of taking off the short side, but take a look at 4. We didn't do anything with it. It wasn't really working for us, but look at how 4 has continued its downtrend. So we put this on a few weeks ago when we thought it could be failing. Well, it did fail, but it still had some short-term bullishness. It rallied through the 20-day into the 50-day, made matching highs, not higher highs though, matching highs. So matching highs told us because it didn't make a higher high, matching highs, continuation of the downtrend. So getting back to that question somebody had about, should we be looking at this because it's above the 10 period exponential? Should we be considering it for a bullish trade perhaps? Well, I think this is a great reminder of why. Maybe not, right? Yeah, we broke the shorter term, but we still managed to bang our heads on former support, now potential resistance. And today, you are now trading through the low of the high day in the bounce back. So that means for a lot of traders, the potential for a continuation move in 4. We're going to look at this one a little later because that's got a December 19th date on it. I'm going to let that one roll. Maybe this turns into a profitable scenario for us very quickly. So we'll look at that one next week. Last week, we put on the Caterpillar trade. We built a 530, 580 long call spread for January. This has started to work in our favor, as you can see. So 530, 580. Let's look at CAT real quick, and then we will wrap it up here. So CAT managed to break to the upside. So it held all of those tails of support back above the 20-day, and here we are at 582. So we are already above our short call. Go back to the now concept, the trade we put on bearishly. Why did we go with an in-the-money long put? Same thing, we went with an in-the-money long call on CAT. When we put that on, we wanted something with a higher delta. You can absolutely do it with a lower delta, decreased likelihood of the trade working in your favor. But we went with a higher delta, which meant more cost. But the trade currently is working in our favor. We are long the 530, short the 580. If it stays above the 580 from here on, we're looking at our max gain situation. If it just dawdles along the level at 580, then we might be afforded the chance to cover the short side, the 580 call, and allow our 530 nothing but upside. Basically lift the lid on our spread. We can do that, but we've got a lot of time to work with. So we're going to let that time work for us by hopefully showing a decay in value of the 580 call. That would be great for us. Okay, so that's going to, excuse me, that's how we're going to handle the Caterpillar trade for the time being. We're going to let it roll. Hopefully it continues in our favor. And if we go another week or two and it just dawdles along that 580, 585 area, we have an opportunity perhaps to cover that short contract and maybe make a little bit more out of the trade. But we'll maybe evaluate that next time. So with that, let's go ahead and wrap things up. Reminder to follow Mike and me on X. We try to post for you there each day of the week. At least I try, and I know Mike does too. It's difficult for us with all of our responsibilities, but follow us on X. Mike Fairborn CS and Kevin Horner CS. And don't forget to make sure that you're subscribed to the YouTube channel and get all of the notifications where we are live each day. We're online live on the channel at market open until about 4:45, 5 o'clock Eastern every day. So 9:30 to 5, Monday through Friday, at least non-holidays, that is. You can find us live. Now, this class is being archived. It is going to be available for future view. I have that link right here, as a matter of fact. So I'm going to put this into the chat for you all. If you want to catch up on old classes, this is the link to do it. And if you like today's conversation, you can hit that thumbs up button for me below, and that'll help us when we get this archived, and it'll let more viewers come to this particular one. And I thank you, Mike, for reposting the survey opportunity. Would value all of your thoughts. Please take a minute to complete that. Any comments you make, those come to me directly. So would love to hear from you. With that, I will wrap it up. Thanks for being here. Thanks for participating in the show. And I look forward to catching up with y'all again real soon.